Assalamu Alaikum everyone, welcome back to another video. I hope you're having a great day. Investing in the stock market sometimes can be a bit lonely, and sometimes it's very important to look at existing portfolios, especially those owned by famous investors like the Warren Buffetts, the Kevin O'Leary's, the Bill Ackmans, you name it. And the reason I like to do that is because it kind of gives me an idea that what type of companies they're investing in and why they like to invest in those companies. Because when you learn that, it actually helps you to kind of put together your own matrix, the things that you're looking for. So for example, Warren Buffett always talk about moat. That means competitive advantage. He doesn't like investing in businesses that do not have competitive advantage. The reason he doesn't like that is because when he invests in a company, he invests it for a very long time. So he doesn't want another company to come in the market and then take a share away from that business, and then all of a sudden they'll start losing their revenue. That's the kind of thing that basically they think about. So today we will look at Kevin O'Leary's portfolio, and we're not just going to look at his portfolio. He's got, if you don't know Kevin O'Leary, okay, he basically this guy here. He's part of the Shark Tank. Basically, they call him Mr. Wonderful. He's always on the CNBC and all of that television and talking about different things. But he has a couple of ETFs that he created himself. And one of the criteria for these ETFs was the companies that he's investing in must be quality companies with strong financial performance and solid balance sheets. So that's one. Then secondly, he likes to have a portfolio of basically diversified across different market sectors. And that's it. And the third thing he looks for is cash flow. That means, does the companies have a free cash flow? And if they do, he would invest in these companies. Every single company he owns, in some of those ETFs, apart from one, they basically do pay dividends. And he talks about, if you basically go on YouTube and type his name, dividends, you'll see so many videos where he talks about how much he loves the dividends and how much he's learned from that, from his mother and so on. It's absolutely amazing to see basically how passionate he is about that cash flow. And who wouldn't want to have basically passive income? I mean, in my portfolio, apart from just a couple of companies, all the companies I've invested in actually do pay dividend. Okay, and the reason I like that is because they actually are paying me while I sleep. And if I can grow that, say for example, if I can have a passive income in the thousands every single month coming from my investments, then you can easily quit your job and enjoy the rest of your life if that's what you wanted to do. Okay, so that's the reason I look at his portfolio and see, look at his portfolio and see some of the companies he's invested in. And today we're going to look at 10 different companies on the top, basically 20. I think I picked it from top 20 because there were a couple of companies that were not compliant, Sharia compliant, so I left those out. So let's have a look at the companies that he's actually got on basically in the order of from 1 to 20. So I picked, so it's 1 to 10, but I picked about 1 to 15, I think it was. So the first company we're looking at is J&J. J&J is in the healthcare sector. They have 2.47 dividend yield. They have grown their dividends, dividend growth rate of 6% in the last 5 years. They have dividend safety of 99%. That's the highest any company gets from simply safe dividend. They have been paying this dividend or increasing this dividend for 59 years in a row. Okay, so look at this. They are paying you about 2.5%, and they have increased that about 6% every year in the last 5 years. Safety wise, on average that is, and then safety 99%. Why is it so safe? Is because of this free cash flow here. If we jump from profit margin, and the profit margins are 22%. 22% profit margin. What this means is, after the company has, so you get a revenue, you paid off all the debt, everything the company needs to pay overheads, what they left was about 22%, that profit margin. Then out of that, free cash flow is now up almost to $20 billion. They have $20 billion in the bank. So they are able to pay this dividend without no problem. According to Morningstar, it's slightly overvalued at the moment, about 10%. but it's a great company. It has a great balance sheet, okay, and is the number one in one of his ETFs. The next company is Procter & Gamble. Again, similar sort of a situation. 2.25% dividend yield, 4% dividend growth rate in the last 5 years. Dividend safety 99%. Again, they have increased their dividend 65 years in a row, and profit margin 18.52, and free cash flow of almost $14 billion. They are overvalued at the moment, and they have been for quite some time. What has happened to this company was 2021 and 2020, especially 2020, it wasn't actually overvalued, it was undervalued. And that's when I started actually purchasing this company, because everybody else was more worried about, those high speculative companies. But since we've now switched from growth to more of a consumer staples, more of a defensive stocks, because of the people are worried about recessions, people are worried about, interest rates going up, all of these things, it's actually gone up quite a bit. And that's probably one of the reasons. Again, second company in his list, again, very great company, quality business. The third company in his list is Microsoft. Microsoft doesn't have a great dividend. Okay, it's less than 1%. But in the last 5 years, they grew this dividend actually about 9%. Safety, 99%. Last 15 years, they've increased this dividend in the last 15 years. So they have been paying and increasing last 15 years. Profit margin of 38.5%. And then you've got $60.69 billion in the bank. And right now it's 20% undervalued according to Morningstar. Morningstar does not, basically they look at the intrinsic value of the business. So that means what is, if you were to buy this company right now, how much would you pay for per share? Okay, so that's the intrinsic value in cash. What would you pay for this company? And based on that, what they think right now is basically about 20% discount. And they are very conservative when it comes to that sort of evaluation. The next company is Home Depot. Home Depot is paying right now 2.45% dividend yield. In the last 5 years, they have increased the dividend, about 18%. Safety of 87%. In the last 34 years, they have increased their dividend. And profit margin of over 10%. Free cash flow about $14 billion in the bank. And they are overvalued at the moment. Now, look at the top 4 now in his list. Every single one of these companies has a massive free cash flow here. And that's something that he talks about all the time. If I'm a new investor and I'm basically new to the market, these are the companies that I will target for. Because by buying Johnson & Johnson, you know their product, you know what they do, you know basically Procter & Gamble, Microsoft, Home Depot. They sell tangible assets that we use all the time. So it's easy to get your head around, and they have been around for a very long time. They have a great balance sheet. The profit margin looks good. You just need to buy them basically at the right time, at the right price. Right now, 3 of them are overvalued, and 1 of them rightly so, because they're great companies, and 1 of them right now is undervalued. The next company we're going to look at is Pfizer. I'm sure you all know Pfizer, pharmaceutical company, healthcare, 3.26% dividend yield, 5-year growth rate of 5%, 75% safety. So normally they say anything below 60 is quite, they might not have room to improve, but and all that stuff, ratio might be a bit low and all of that stuff. So you have to be careful. But anything above 60, that's absolutely fine. In the last 11 years, they have increased this dividend in the last 11 years, profit margin of 27%, and then maybe in the next couple of years, this company might actually increase this because of the COVID vaccine and so on. Free cash flow, they've got almost $30 billion and currently fairly valued. Fairly valued at the moment. So that means if you were to purchase this, I'm not saying you should do this, you should do definitely your research. You're actually buying at the right time. That's what it means. So these 3 other companies are overvalued based on their intrinsic value. Microsoft is slightly undervalued or discounted at the moment, and basically Pfizer is fair valued at the moment. Next one is Eli Lilly, again another healthcare company, 1.36% dividend yield, 11% dividend growth for the last 5 years, dividend safety of 96 years, increases. Basically, they've increased their dividend 31 years in a row, profit margin almost 20%, free cash flow of $5.38 billion. Overvalued at the moment, is one of the companies that I've been looking at for a while, and it still looks overvalued at the moment. So I wouldn't touch it until it actually becomes either fair valued or discount. The next company is Cisco. We've talked about Cisco for a very long time. It's on my list as well. I would love to add this company because it's a solid business. They pay 2.91% dividend yield. Okay, they actually becoming more of a defensive stock if you think about it. They have been around for a long time. They pay solid dividend and they have a great business model that everyone needs. Even COVID time, when everyone basically was locked away, people were buying these network devices to kind of actually communicate with their employees and so on, employers and so on. Okay, 5-year growth rate of 9%, dividend safety 91%, 10 years of basically increasing that dividend, profit margin of almost to 23%, $13.7 billion of free cash, and unfairly valued at the moment. Another great company. They all have a lot in common. This is the free cash flow here, the dividend yields, and then the safety. This guy is, trust me, he's smart. Look at that ETF. I'll put the link there. Have a look at the companies in that ETF, and then you will tell me what you think about. Next one is Texas Instrument Incorporated. This company we've not spoken about a lot, but it has been actually under my radar. But by looking at this, I might have to do a little bit more research on this company. 2.6% of dividend yield, 21% 5-year growth rate. So this is the highest in this list. Okay. Safety of 90%, 33 years of increasing that dividend, profit margin of 42%. This is basically in the chip maker semiconductor company. So 42% is quite high. Then you've got $6.2 billion in the bank of free cash flow. That's a lot. That is really a lot. I'm actually surprised the profit margins this much. Remember, by the way, all of these things is in the past. So you now need to think about how the company is going to do in the next few years. Okay, so you can't just take this and say expect it to grow this much in every single year in the next 10, 15 years. So you have to think about that side of things. Okay, so this doesn't tell us, the fact that the companies are going to be, great companies in the next 10 years and will give you the same sort of returns. Profit margin is very important, really, really important, because that shows how much the company is actually making from their revenue. So after they paid all their taxes, they paid all their overheads, how much of that money is actually going to the bottom line, and then how much of that is going to become free cash flow so they can invest in the business. It's fairly valued at the moment as well. The next company, the 9th company, is Apple Laboratories. This is another healthcare company. As you can see, there's quite a few healthcare companies in this list. So we've got about 4 so far. Okay, 1.55%, 5-year growth rate of 12%, 71% dividend safety, 50 years of increasing that dividend, 16.42 profit margins, and the free cash flow of almost $9 billion. And the moment is basically overvalued. Another great company. Final company we're going to talk about is 3M. 3.98% of dividend, 6% growth rate in the last 5 years, safety of 75%, 63 years of increase in that dividend, 16.75 profit margin, and $5.8510 billion in the bank, and right now 21% discount. Right, these are the top 10 that I picked from his ETF. There are more. Okay, I couldn't fit all of this in here, so there are more companies in this. Now, one thing that this shows me is, remember, all of these investors, so when you listen to Kevin O'Leary, when you listen to Warren Buffett, these people always say, invest in companies whose business you understand. Companies that has a massive free cash flow. Companies that possibly give you some sort of a cash every single month. Okay, so look at this. Every single company in here are giving you 2.23. That's basically when recession was, not recession, when inflation was about 1%, 2%, whatever, that's beating the inflation. So rather than your money sitting in the bank, you're getting about 2.25%. Right now, inflation is very hot because it's like 6%, 7%, 8%, depending on what country you're looking at. Okay, but generally, this is what you will get. Okay, and they have a lot of cash. They're proud to pay this dividend, because if they have been increasing their dividend 65 years, they become dividend king. So J&J and Procter & Gamble will not cut this dividend anytime soon, because they lose that. So they are proud to pay that dividend. Even sometimes, I think it was 3M that increased their dividend by 1 cent a couple of days ago, or maybe a couple of months ago. So they love that side of things. So that's how they basically get you to invest in this business. I don't care. I love that. The fact that they're increasing, that's perfect. And they have got the cash, obviously, in the bank. And the dividend is actually quite good. And the growth rate of that dividend is good. So that means in the next 4 years, 5 years, I will get increase. This will grow up, basically get bigger and bigger. Okay. And that is the kind of business you should be invested in. Yes, we talk about, the growth stocks, which are absolutely amazing. But if you want to sleep well at night and basically, have some of the businesses that you don't have to worry about their business model going out of business, or like Home Depot just closing all their stores, or 3M stop selling all these products they've got thousands of products, 3M. If one fails, they've got another 1,000 something still. Okay, Cisco, almost every single business that out there uses Cisco product. It's very difficult to actually change from their product to another company or competitor, because you have to integrate like all of those new systems into your old system, which is very difficult. So they have some sort of a sticky business that they actually own. Okay, Microsoft is a similar thing. If you've got Microsoft products, it's very difficult to change to any other companies. So whenever you go to the grocery shop, you just buy Head and Shoulders, because that's my favorite. So every time I go, I don't even think about the price. I just pick it up. So right now in inflation times, where the prices of everything is going up, they have pricing power. This tells me they all have pricing power, a lot of these companies. That means they can increase their product, the price by say at least $1, and you wouldn't even feel it. You just get it. You just take it. And I bet you every single one of these companies, have a wide mode. I should have included that, but I'm sure they all do. Okay, I'll check that out, but I'm sure they all have a wide mode. That means they have a competitive advantage over their competitors, and their product is actually in demand. Right, I hope you enjoyed the video. Okay, that was looking at, the Kevin O'Leary's ETFs. I will put the links on the description. Have a look at that. When you're investing in the stock market, it's not just one thing that's basically, you don't buy one type of stocks. You have to diversify. So you can have a bit of your growth, but obviously your core companies that you invest in, the J&Js, the Microsoft, the 3Ms, whatever, those Home Depot, some of the stocks that we just talked about are my top 5 in my portfolio, And the reason for that is because I know the fundamentals look great, and I actually like their business models. I hope you enjoyed this kind of video. If you do, please subscribe to the channel. I hope you have a great day. Assalamu Alaikum.